All right, welcome to Flip Arizona. You guys can follow us and be a member on meetup.com, Flip with two P's, Arizona. Also follow us on social media, Facebook. And what we do every month is we bring something of value to you guys as people who are involved in the fix and flip community. A lot of investors. Our members range from people who are, first-time flippers, mom and pop, to, wholesalers that are doing, high volume. Every month, what we do, if you don't already know, if you're watching this, you probably already know us, but just in case we have some new people watching, what we do is myself and Philip, aka Philip Zweig, we have put together Flip Arizona. And we bring a new resource, something of value to you guys each month. It's free of charge. It doesn't cost anything. And you are welcome to plug in with this said resource, make them a member of your sphere, utilize their services, partner up with them, develop relationships. Doesn't cost you anything to be a member of this group and to have access to this information in these meetups. Normally we do meetups live. I bring pizza and we have a good time. Right now we're sort of in the middle ish of the shutdown, so we're doing it via Zoom. So a little bit of background on Flip Arizona, a little bit of background on me, and a little bit of background on my partner in crime, Philip Zweig. And then we'll talk about our awesome keynote speaker, Julius Mendoza. So Philip, aka Flip Zweig, is a fix and flip expert. He's been involved in fix and flips for over 20 years here in the Phoenix area. He pretty much knows everybody and knows everything about fix and flips. He's a wealth of knowledge. He's a great resource to have. He's also a mentor. So he does offer education services and mentor services for people who really want to kind of get up on their feet and do some deals. So this is his brainchild, Flip Arizona. I am a marketing manager. I'm a marketing specialist with Magnus Title Agency. We are one of the biggest market shareholders in the greater Phoenix area of title and escrow business. We have 15 offices throughout the valley. We have some of the most experienced escrow staff, and we have a great marketing department, and I am a part of that marketing department. So what I do is I help investors and I help realtors grow their business. I bring resources, I bring knowledge, I bring scripts, I bring tips and tricks, custom design work, printing, and data. For investors, a lot of times the most important thing they want is data. So that is one of my specialties. I have done fix and flips myself. I used to be a realtor in California and Arizona, and I'm on the marketing side now, and I pride myself on seeing all ends of things as opposed to just being a marketing person who doesn't really know what a realtor or an investor needs. That's kind of cliff notes on us. And in a moment, we're going to turn it over to Julius Mendoza, who is a regional director of I believe the biggest fix and flip lending company out there. I know they've done over 5 billion. Julius, is it over 5 billion in loans?
Yeah. So we've been originating for 5 years, and in those 5 years, we've originated over 5 billion in loans. Correct.
Now, I'll give you I'm going to give a little bit more of an introduction to you here in just a moment, because I know you personally have been involved in over like $125–130 million in lending transactions, and you are the regional director. You work with some of the biggest clients out there that you guys deal with. So I'll give you a little bit more of an introduction here in a sec. But if you don't mind, Flip, is it cool if I ask you a couple questions, and I just have some things I want to ask you, and maybe you and I can have a little bit of a chit chat, and I want to get some information from you about what's going on right now in the market. Is that cool?
Absolutely. Good to see you tonight, Jason.
Yeah, likewise. So first of all, how are you?
Staying extremely busy, doing well. Everyone's healthy, thankfully. And, miss seeing you and seeing the meetups that we have pre-corona, but I'm
Yeah.
sure we'll get back to them. And, it's always good to connect. And
Yeah, it was fun. We had good times. We were man, I mean, we were bursting at the seams. We had to keep changing venues because we had so many people showing up, and that was cool. So I look forward to getting back to that, but we're trying to be responsible right now and respect everybody's, space.
I know we will. And again, we got the auditorium down in Central Phoenix, so it's a great location for everyone, and looking forward to that. But doing the
I
best.
think that I think that facility I think that holds like 150 people or
Yep.
so.
Yep.
Yeah, so I can't wait to get back to the pizza and the refreshments and the live interaction. I think a lot of people are kind of fatigued with the Zoom thing, but I got a couple questions in general. Can you give us maybe some sort of loose market update for Arizona, for Phoenix right now? Like, what's your kind of general opinion on things?
Locally here, we've been there's a shortage of inventory. So like June, I closed 6 deals, and these were all fix and flips. And so I had the biggest month in like 10 years of net profits. So like as soon as I listed them, because all of them were affordable housing. And what I mean by affordable for out in Arizona, under like 400,000, and they all sold within a week to 10 days. And so that was encouraging. I talked to a good buddy of mine who's in mortgages. Same thing. His June numbers he's been in it 18 years, best month ever for him. So a lot of refis happened. Ton of business in Arizona. Businesses are moving here still. We have the Amazons. We're pushing to all like outreaching areas, Goodyear, Avondale, off the I-10 there. The builders are just building in masses, like tract communities. They're starting something new that I don't know if a lot of people know about right now, but the rental market is very tight. So what that means is like it's hard to find affordable housing. So we got some national builders that are coming here and building homes. And basically what they're going to do is use Arizona as kind of a starting ground. So the whole community, they're going to rent those homes. And I'm not sure if it's lease options or straight rentals, but that should be an interesting thing that is going to add to our economy here. And
That's interesting that you point that out. In fact, a lot of people don't know that Phoenix, Arizona, first of all, 5th biggest city in America, fastest growing city, fastest growing county is Maricopa County. Yet again, we get people from all over America, specifically a lot of people from California for obvious reasons moving here. A lot of people from Texas, Washington, Illinois, and some from Florida. It ranges from baby boomers looking for, a dry climate to live in, all the way to young tech professionals looking for affordable housing and low cost of living. But we have a lot to offer. We have, let's see, what was I going to say? I was going to throw out
I was mentioning the rent to own concept by the national builders that are coming here.
Right. And a lot of large companies and corporations, I got sidetracked, but a lot of large companies and corporations try their business models out here in Phoenix, because we actually have a really, really accurate sort of representation of the cross-section of America as far as demographics go. Age, income, ethnicities, gender, it's all encapsulated really accurately and really well here in Phoenix. So when you look at companies like Uber or let's see, I think certain food delivery platforms and things like that, one of their number one test markets is Phoenix, Arizona.
Amazing. Yeah. I mean, I have a lot of guys reaching out to me since I built up my social during the pandemic, the Instagram, the YouTube videos. So I have guys coming down here, at the office, because I'm in Tempe right off the Warner and I-10. And so I have younger guys that are coming here and saying, is now a good time to get into fix and flip wholesale? And my answer is absolutely. There's not a better time, because there is some fear out there. And again, there's so much going on in real estate. It just, it's amazing. Even with the pandemic, we are just closing deals. We're like, every day is like really extremely like 10, 12-hour days. So we're really busy right now. So it's exciting to see everything happening. I do have a number of friends out in LA and California, as I was mentioning to you guys. And, I had a buddy call me. He's like, Flip, I got to talk to you. What should I do? So he decided with him and his twin brother and his fiance, they're going to come out in October from LA. They're going to rent a Airbnb for about a month. They're going to see if they like it out here, because they're going to spend about $500. So they want to make sure they like it, because they've been in LA. They're born bred. That's all they know. They're going to test this, and they're going to test Texas. But I thought it was interesting. So I'm getting into Airbnbs pretty big too right now, because that business model is really strong, believe it or not. And so, we're full on with the Airbnbs. And so what they're going to do is test out which state they like best. And so it's, we're getting a ton of LA folks out here.
Hey, if they come out in October, make sure it's not early October. Make sure you get them out here during the second half of October, when the temperature is nice and awesome and pleasant. But
yes,
it's like the 15th or the 20th of October where it finally gets to that awesome, perfect temperature, overnight.
Yeah. And to parlay on your point too, Jason, my nephew came out from San Francisco, Julius. He had a single, like, small studio. He was working at a tech company. He's like 23, 24 and doing real well, but they let him go. And he said, his mom wanted him to come out here. So he just moved not long ago, but like for what you could buy in Arizona compared to San Francisco, you get a lot of house out here. And he was renting there, and now he's going to buy something. And, it's a different economy of scale, of course.
Well, and it's important. A lot of people don't, a lot of people, I remember last year, they were talking about waiting to see what the market had in store. And, last year, do you remember everyone saying, oh my God, this is the most unbelievably crazy seller's market we've ever seen. We're going to wait for it to cool off a little bit, be a little bit more of a buyer's market. Well, we're looking at this time last year, there was about, I think about 15 to 16,000 active listings. Right now, there's about 7,000 to 7,500 active listings. Median home price was, I want to say, in the 340,000s this time last year. Right now, it's just pushing up against 400,000. Now, those active listings, those aren't necessarily flip or reno, opportunities, but still, that, the market for that mirrors the residential resale market. Now, there was a lot of talk for a while about a lot of foreclosures hitting the market, because banks were having this little balloon payment at the end of the moratorium. And a lot of those banks now have tacked that onto the end of the loan, which has allowed people a chance at avoiding foreclosure. So I don't think we're going to see as many foreclosures, but, and again, I'm no expert, but I do think there's going to be a lot of people, unfortunately, out of work.
Yeah.
And, you can tack those 4 or 5 months onto the end of the loan, but if you don't have a job, you don't have the ability to pay your mortgage. And a lot of those people, unfortunately, are going to delay the process and think that they can restructure their loan, or they can get some sort of assistance, and at the end of the day, they're going to be pushing up against an auction date. And I think those are the people who would be happy to, talk to, an investor and spare their credit and make some money on the way out and avoid foreclosure. What are your thoughts on that?
100%. Yeah. So we started our Driving for Dollars campaign again. So we're actually reaching out. We have a team that knocks on doors. You know, we stopped that, and now we've been revving that back up. So yeah, there's a lot of opportunity for us to help people that may be in a tough situation based on, you know, upcoming foreclosure. So yeah, we're really out there full force, back at it, meeting with folks. Because there are going to be uptick, like you said, Jason, in foreclosures. We know that, and unfortunately, you know, some people are losing their jobs and you know, falling behind on payments, and so we'd like to help them before it's too late, where they
Sure.
actually lose the property and to the bank and lose their credit too. So
Sure.
you know, we're actively meeting with them, and we're doing more phone meetings, so closing on the phone versus in person. But again, we're generating leads from the door knockers, which is great.
Good. And just as a side note for anybody watching, again, myself as a marketing manager, I have access to all sorts of data. So a lot of people, you know, might be wondering, well, how do you find out where the pre-foreclosures are? How do you find out when the NODs, notice of defaults, are going out? How do you find out when the auction dates are? How do you find out the names and addresses of these people? That's all stuff I can help with. But I think maybe lastly, I'd like to ask you, can you tell some people out there, you having decades of experience, if you were sort of a new investor, or just even an investor with experience right now that's a little bit unsure of what to do, can you give a little advice as to what you're doing and what you would recommend people do right now?
Well, I mean, I could tell you what I'm doing, and personally, and for our businesses, we're buying at a deeper discount. So, you know, you got to watch your numbers. The market's still going up, but like, I just feel better buying it at a 10% less clip than we were buying previously, just to secure ourselves. So I definitely make sure you get with someone who knows how to do your ARV, which is your after repair value. So if you get into a fix and flip, it's important that you buy it right. So meaning you need to know how much of repairs and renovations to resell it at a profit. And so it's important to get the data correct, and a realtor who knows how to analyze deals to price them correctly when you go to sell them in, you know, 90 days. So that's very critical. And again, just buying them right. And again, we're just hedging. We don't want to, you know, for the market, I don't think it's going to go down, but like, we just want to provide ourselves a little more cushion on our purchase price.
And on that note, I'll just touch on a couple facts, couple statistics. Like I said, it was looking a little bit scary with the foreclosures and the balloon payments, but it's not looking nearly as bad as people thought it was in March. We have our inventory is so extraordinarily low right now. It's people are still there. The demand is extremely high to move here to Phoenix. Average days on market, and again, this is residential resale, but you know, the investor world kind of mirrors some of this. Average days on market is less than 2 months. You know, the home prices are going up. People are still moving here in droves. The rental market is super, super good, meaning there's no homes available for people to buy, and you know, renters turn into buyers. So there's a lot of indications that it looks like we're in a unique situation to where this is still going to be a really good market for years to come. Our economy is one of the best in the nation. So we're somewhat insulated to other places that are a little more vulnerable, places that are losing people rather than gaining people, places, you know, where there's a lot of inventory and there's not much of a demand, and therefore probably, you know, it's a little bit less appealing to, pick up a property as an investment, as a flip. It's going to sit on the market longer. Your carrying costs are longer. So anyway, just a little bit of general notes on my end. Do you have anything else you want to kind of add in there, or anything you want to?
I'm real excited again about the opportunities for myself, for new investors, for guys who have been doing it 5 years. There's a lot of people in the market that are wholesaling, that are getting into fix and flip. But again, there's so much opportunity because there's so many houses out here. There's like, I don't know the exact numbers, but I believe you said it's the 5th largest in the country.
5th largest city, yeah, and fastest growing.
And fastest growing. And so again, I won't be in it for 20 years because I'm going to build up my portfolio and then build the education, then travel. But I believe the next 20 years, amazing growth in Phoenix and surrounding communities.
And before we turn it over to our awesome keynote speaker, Julius, can you please tell the folks out there how to get in touch with you? And again, if I haven't made it clear, what Flipp does, what Philip does, is he mentors investors. So whether you're a first-time investor or whether you're somebody that does 10 deals a month and you want to turn it up to, 10 deals a year and you want to turn it up to 50 deals a year, or you want to start wholesaling, Flipp is your resource. He's your guy. He offers education programs, mentorship programs. And even if you don't participate in some of those official programs, he's a great person to have in your phone and to know and to follow on social media. So don't miss this opportunity to connect with somebody, this important, who's connected to so many other people in this investor world. Flipp, can you tell us how to get in touch with you on social media, how to follow you?
Yeah, awesome, Jason. So thank you. So during the pandemic, I started Instagram. So it's just go to flippin_AZ. You can see my daily posts. We post a lot of the before afters, a lot of the starting, like videos showing the whole process of a fix and flip. We do a lot of whiteboards there. And then you can go to my link tree under my profile, and it shows all the other platforms. And then I just wrote a free ebook that tells about the formulas I use to scale my fix and flip business over the past 2 decades. And that's absolutely free. So you can get that on the link tree. And then any of the other platforms are there too. So, and then we do a daily or weekly live show called Cut the Curve, Jason, where we interview moguls, mentors, and serial entrepreneurs. So just check out our feed for that on Instagram. And we're on there once a week with a new guests from around the country.
Perfect. Okay. I know that Julius has a presentation ready to go, and I think he's got about 30-40 minutes worth of material. We'll see how that goes. We'll open it up to Q&A afterward. Let me tell you a little bit about Julius, and then I'm going to turn it over to him, and he's going to be host for a while. So I've had the pleasure of getting to know Julius Mendoza. He is a regional director for LendingHome. LendingHome is the biggest fix and flip lender, I believe, in the nation. Julius can give you specific stats on that. They've done over $5 billion in volume in loans. Julius himself has piloted several loan programs that are very successful. He's going to talk about those today. Brings a lot of value to you as an investor. And he himself has been involved in over 120, if I didn't already say that, over $125 million in first loan fundings. So that's a little bit about him. LendingHome. Well, Julius is going to give you a walkthrough of who they are, what they do, what their mission statement is, the different programs they have to offer. And he's going to educate us a little bit on sources of funding, when to use private, bank, hard money. Going to talk about a few recent case studies, some deals that they've done, kind of describe those to you. And he's also going to kind of give us his thoughts on, how the market's doing right now, and given the shutdown and the pandemic. So Julius, I don't know if you had all of those things planned. Maybe I dropped a couple things on you, but we're interested to hear what you have to say. We really appreciate you being a part of this and bringing us some value. And I'm going to make you the host here in a second. Let me see if I remember how to do that. Make host. All right.
I'm the host now.
There you go. Hey, Julian. Or Julius. I always want to call you Julian because I got a buddy Julian. So good to see you, Julius.
Yeah. Thanks for having me. It's a real pleasure to be here. Jason, you pretty much said everything I was going to talk about.
All right. Well, you guys have a good night. Okay, we'll see you.
I'll go ahead and share my screen, gents. So yeah, again, my name is Julius. I'm the regional director for LendingHome. That's my phone number there. So LendingHome, we've been around for about 6 years now and originating for 5. I've actually been with LendingHome since we first started originating loans. So back then, as you can imagine, we were in super startup mode. There was maybe 30 of us, scrappy little building in San Francisco where we're operating out of, where we were walking over each other to like try to get to different parts of the office. Like ops was super cooped up with the sales team, and it was just quite the interesting experience, you know, seeing it come from a startup to where it is today. So when I first started working at LendingHome, we were maybe doing around 10 million in loans. Since then, as you mentioned, Jason, we've established ourselves as the largest provider for fix and flip financing in the space. And that's just based off of the numbers. So as you said, over 5 billion in loans, over 23,000 in transactions. Our mission statement really is to help people live better through real estate. And part of how we do that is through financing deals for real estate investors. Because a lot of real estate investors are picking up properties under value, getting people out of bad situations, let's say, rehabbing the properties, revitalizing the neighborhoods, and henceforth helping people live better through real estate. So Flip, you said you're doing a lot of homes for affordable housing. You're providing housing for people to live better through real estate. So that's definitely something that we really harp on as far as like what we're looking to do and aim to do with loans. And then as far as what we're trying to solve for people that operate when it comes to lending, we really think that for all operators, whether you're a first-time investor or someone that's an institutional guy that's doing 50 a year, we think there are 3 things that we feel are very important when it comes to funding the deals and when people are working with lenders. So that first one is speed and ease, right? So how fast and how easy it is to get the loan. Because we know that it's not investors' jobs to push loans around, right? That's not their job. Their job is to go out there and find deals. So the easier we make it for the funding, the more you can focus on what you do best, which is running the operation. The second thing that we strive to solve for too is reliability. So when it comes to reliability, I like to think that means that it's us being able to do what we say we can do, close on time, because we know that reputation and you building a brand is super important in this industry, right? Whether it's with other investors, wholesalers, the sellers themselves, as you build that brand and reputation, people are going to come to you when there's a deal available for you to pick up, right? And part of that is performing on closing dates and closing times. And then the last thing that we think of, and this is something that people always kind of try to ask me early on in the conversation. I talk to somebody, hey, what are your rates? Hey, what are your terms, right? But it's cost, right? Just making sure that the loans are competitively priced. We don't want to eat into your spread. The more money you have in your pocket, the more you grow, and the more we grow. So one thing that we really look at too is when we work with real estate investors, we don't look at real estate investors as like a client or a customer. We really like to think of it as a partnership. So we want to help you grow and scale your business, just like we're looking to grow and scale ours. So again, the 3 things that our loans look to solve for are speed, reliability, cost for the most part. So now, Jason, as you mentioned, I would like to talk a little bit about different funding sources and the advantages and when you go to one source or another, right? So I've talked to a lot of cash buyers, right? Now, some guys have, they say, unlimited amounts of cash, right? Or they can just buy all their properties cash, and that's awesome. Not everyone has unlimited deep pockets like that, right? So cash can get you somewhat far. Like, let's say your cash can get you a couple houses a year, right? So at that point, cash is cheap because you're not paying any interest or fees or anything like that, right? But if you're missing out on opportunities because your cash is tied up, or you're not able to scale to the level that you want to scale at, let's say you want to buy 12 properties a year, but you only have enough cash to buy 2 properties a year, right? That's when cash can get pretty expensive. And that's when you want to leverage other people's money, right? So private money, you can meet a private money lender at an event like this, if it was in person or if it was Zoom, whatever, right? This could be your father-in-law, rich dentist, rich doctor, right? Someone that's looking to invest their money but doesn't know quite where. Well, you can definitely leverage their money just by securing it with a deed of trust, right? So with private money, often as the relationship grows and the trust is there, they can offer pretty sweetheart deals, super fast funding, whether it's for a first lien position or a second lien position to bridge the gap when you're working with other types of lenders. I remember I was in Las Vegas once with someone that we work with, and we were talking about how we could work more together, right? So he said, well, my private money hasn't hit capacity yet, and it's just too easy, and it's just too cheap. And I asked him, okay, what's your process like? I'm just curious, like, how do you get money from your private money lender? And then he goes, well, let me show you. Let me show you an email. So here's the purchase price. Here's the rehab. Here's the ARV. And then the private money guy responds with the letter K and wires the funds, right? And that's probably a relationship that they've developed for like years, right? So yeah, advantage of private money is it's fast. You can get high leverage. You can get super low rates with zero origination often. But one thing with private money is that it is finite. So what I mean by finite is that the money can run out. So your private money lender that has 500K here, and then maybe you have another one with another 500K, and you have another one with $1 million, right? Let's say that they're not only lending to you, and then you got a couple deals that you're working on, and then another one comes in the pipeline, and then let's say you call your guys and well, they're out of money, right? So you have this deal under contract. They don't have the money to fund the deal because their money's out there, right? Now you might find yourself, unless you have other lending partners, scrambling for the financing, right? So that's one thing with private money, or like you're calling different lenders to see who has the money or not. So that's why it's good to have other sources with deeper pockets like bank financing or hard money to augment the financing of private money. So often people that are using private money will come to us in that situation when the private money is at capacity. Now, when it comes to bank financing, whether it's short-term or long-term, let's say it's short-term money that you're looking for bank financing, they can offer lower rates, right? Very low rates. We all know conventional rates are great. Very low to zero origination. Often if it's a regional bank or a local bank and you have a good relationship, you can set up lines of credit, right? Which are going to be just as good as cash when you're buying the properties. But again, lines of credit are finite. And then with bank financing in general, if you're doing like, whether it's short-term money or if you're trying to do like a long-term rental loan, it's going to be a longer closing time. Obviously, it's a different process when you're going to conventional. It's going to be a little more paperwork, a little more work in general, right? And then you're looking at a 30 to 45 day close. So if you have the time to both, close and actually like work on the loan, bank financing can be a good option there, but it is a tighter credit box, maybe a little more money down, lower leverage, but for the bank rates, right? Those low bank rates. And then lastly, I think hard money is kind of the nice synergy between the two of private money and bank financing, because hard money is faster and easier than bank financing, albeit not as fast and easy as like private money, but it's a good hybrid, like kind of in the middle when it comes to speed. Because when you're working with a hard money like us or a different lender that specializes in fix and flip, I mean, they understand, right? A lot of the originators that work at LendingHome, they actually are investors too. So they understand what you're looking to do when it comes to the property itself. They actually go in there and clear the scopes of work to make sure that the projects look good and they're feasible and so forth. They work with the valuations team to make sure the deals gets through. And, you know, with hard money, you can close in a week, right? On average, if you're working with a hard money lender that's reputable and you've worked with them in the past and so forth. So process and time to close, you can still write pretty competitive offers, right? Depending on which program you're set up with us, and I'll explain closing times in a bit, but, you know, you can be writing offers anywhere from 10 to 21 days to be a little more competitive. And then it's institutionally funded. So basically what that means is the well won't run dry. We'll always have money to fund your deals as long as they fit within a certain box. And then obviously no two deals are alike. You know, there can be room for exceptions at certain times depending on the deal. But the way it works with us is we've raised over the 5 years that we've been originating about 200 million capital. And then we call that the opportunity fund. So with the opportunity fund, whenever a deal funds, we use some of that money to fund the deal initially. And then we'll balance sheet the loan for probably a couple of weeks on average until we find an institutional takeout investor to buy the loan, right? So once we sell the loan, they basically make money on interest. We make money on a small origination, and that's usually how we do it. Although we do have zero origination options in Arizona specifically, which we'll get into in a little bit. But because we're institutionally funded and we're selling the loans to hedge funds, big banks, or private hedge funds and securitizations that we locked in, the well won't run dry. So you won't have to go lender to lender as long as, you know, it fits our box, which our box, it's anything, it's residential, non-owner occupied, 4 units or less. So we get loans both for the fix and flip and also the long-term rentals as well.
Julius, can I interject a question here? And honestly, I don't know quite how to articulate what I'm asking, but
yeah.
So you mentioned bank financing. So
Yes.
if you fix and flips, at a certain point, those banks are going to say, you're an investor, you're a flipper, we don't want to do short-term loans with you.
Some will.
False. Or they'll say your interest rates are going to be higher. I'm not going to give you a regular conventional, you know, rate. Can you touch on that? I might be wrong, but I seem to know that there's something along those lines that can happen traditionally with conventional loans with a bank. Can you touch on that?
Yeah, absolutely. I mean, to your point, loans can fall out because they don't fit that conventional underwrite, right? They may not be looking at the ARV. They may be looking at part of it as the as-is value, right? And if the house is gutted or if the house is trashed, right, it may just fall out and you may not be able to get the financing. So that you do bring up a good point there too.
If they have you flagged as a flipper, if they look at, if you apply for a loan and they look at the last, you know, 2, 3, 4 months or whatever of your financing and or your history, and they see that you've done 2 or 3 deals and you're flipping them, I mean, will they even give you a loan, or will they just hike that rate way the heck up? Like, how does that work?
Yeah, that's a good question. I mean, I wouldn't be surprised. I think it depends on the underwriting guidelines of that specific bank. I mean, if someone that is going to a regional bank and has a great relationship with the banker, then they might be able to pull some kind of strings for them if there is a rule like that in the underwriting policy. But if you're working with like a bigger bank, then yeah, for sure, I wouldn't be surprised if that situation at times.
Okay.
Yeah. So when it comes to reliability, I mean, yeah, if you're going with a hard money lender that's specializing in fix and flips, whether it's us or, you know, one of our competitors, then yeah, it's going to be a much more reliable source for sure. Because I have had guys talk to me about bank financing where they're coming to us because they were trying to close with a great rate, and then it'll fall out, and often they don't understand why it did fall out. So that does happen for sure. When it comes to like investment property loans, right? Cool. Any questions from you, Flip, or anything before I move on? Or anything to add?
Yeah, I was just curious. I don't know if Jason, if you guys covered this question, I had to step away for a minute, but like, are banks tightening up from your perspective right now on doing traditional loans, their criteria?
Yeah, I would say so, but I think things are starting to loosen up. So
Okay.
we are seeing some thawing in the markets, and we're seeing some loan programs come back, and some lenders that were saying they weren't lending at all come back too. So I think things are starting to get better.
Gotcha.
Yeah, for sure. And I'll cover that with a little story in a little bit too.
Okay.
Yeah. Cool, gents. So now what I would like to touch on is just a little bit about our overall loan programs. So what we offer. So there's two types of loans that we do. So the first one is your fix and flip, and then your other one is your long-term rental. So I'll start with the fix and flip loans. Basically, these loans are 1 to 2 years for the term. You have two different programs depending on experience. So one is if you have less than 5 flips in the last 2 years, and then the other one is if you have more than 5 flips in the last 2 years. So a flip to us, it's anything where you bought it and you took title, let's say, or if you're a part of an entity where you have at least 25% ownership and that entity took title. So held for at least 30 days, but no more than 3 years, and then sold in the last 2 years. So anything you bought and sold in the last 2 years, or often if you bought it, renovated, and then refied to stabilize, we can get exceptions for those two. So it's either less than 5 flips or more than 5 flips. There's the standard program and the pro program. But for both, it's 1 to 2 year terms, interest only. There's no prepay. So if you take the property down and you gut it, and a couple weeks later, an investor approaches you and says, hey, I'll take it off your hands, right? And you make a small profit, that's cool with us. You only pay interest for however long you hold it for. If you're on the standard program with less than 5 flips, we do an inspection or a walkthrough before closing. They'll take pictures, and then those pictures go to our valuation team. And then our valuation team will put an ARV value on it. That process takes about 5 business days or so, 5 to 7 business days. So once we get the value back, the sooner we get the prelim and other third-party items from escrow, like the very standard stuff, prelim, CPL, wiring instructions, all that good stuff, the sooner we can close. So on the standard program, depending on how quickly we can get that walkthrough done, and depending on how quickly we get stuff from title, it's typically 2 to 3 weeks, 10 to 15 business days. So if you're on the standard program and you're writing contracts, if you put 21 days, that would be safe. If you've done a deal or two with us already, should be moving faster. And at that point, you could probably put like a 15-day close if you want on the contract. Now on the pro program, if you have more than 5 flips in the last 2 years, we don't do an inspection before closing. We don't go in the house. We basically take you through a one-time upfront approval to get you approved for that program first. And then when you do have a deal, we'll just do a desktop review without an inspection. So we'll get that ARV back in a day or two. So because we bypassed that inspection, now we're closing in 5 to 7 business days. And now you can write about 10-day closings on your contracts. So there's the standard and then there's the pro. So that's one big difference. The leverage is the same right now. So for both programs, we'll go up to 85% of purchase, 100% of rehab, with an ARV cap of 75%. So the leverage is the same on both. As long as your FICO is over 720, we can go up to 85. If you hit the minimum of 660, then we can go up to 80. So our minimum FICO score is 660 just to qualify. And if you have higher FICO, you'll get higher leverage and slightly better rates, right? Now on either program, there's no fee to apply. So if you're less than 5 flips, we're pretty much going loan per loan. And then if you're on the pro program, you have an exposure limit of 2 to 3 million to start. We get you a blanket letter you can submit with your offers. But whenever you submit a deal, it doesn't cost you anything. It doesn't cost you anything to get approved. So if you submit a deal and we're at the finish line and title finds something and then we can't fund it or whatever it might be, no harm, no foul. If the deal falls out, no problem. On and upwards to the next one. On each deal, you're gonna get into an dedicated originator. So you're always gonna work with the same person. So it's not like you're working with different people or whatever. And then we're kind of a marriage of a tech company and a mortgage company. So one thing that really sets us aside is our online platform. So once you're pre-qualified or approved, basically you'll have access to that. And then you can go in there to price, submit, manage your deals. So on the front end, when you're submitting and managing your deals, you have access to that. And then when you submit it, everyone that's working on the loans on the back end is going to have access to it too. So it helps streamline the process for both you and the people that are working on your loans. Everything from processing to underwriting to drawing docs to funding to servicing. We service all our loans in-house, even though we sell the loans. It's all going to be done through our portal. And that way things don't fall through the cracks, and that way we don't ask you for things over and over again. I'm sure some people out there have experienced that with some lenders. And that's a result of working with different people or just working through email, right? Everything's organized through our online portal, which is pretty neat.
Julius, quick question.
Sure.
So you said you service the loans, but you sell them. I'm not sure I understand that concept.
Yeah, so we do sell all our loans to either institutional investors or through our securitizations, right? So when we sell those loans, they're making money on that. And then we typically make our money on origination. Although in Arizona, we do have special programs where we can sell the loan at a lower coupon, take our origination into the rate as a spread, and then basically our origination that way, right? There are special programs to do that.
Okay.
Yeah. When we sell the loans, when I say we're still servicing them, our servicing team is still servicing the loans once they fund afterwards. So when it comes to servicing and payoffs, we do that still.
Okay, even though you sold it?
Correct. Mm-hmm.
Gotcha. Okay.
And then that's one thing that's nice about that is payoffs. So I don't know if you ever had trouble getting a payoff, but with us, like if you go on the portal, you request it, it gives it to you right away.
Oh, nice.
Or you could send an email to payoffs@, and you get it within 24 hours. So it's super fast.
And yeah, that is, I like the fact that you guys are technology plus the mortgage. I mean, because that's a missing thing with some hard money lenders. Are, you know, they may be mortgage, but they're not techies. So it's good to know that you guys combine both of those.
Yeah. I mean, our CEO, Matt Humphrey, when he first basically was thinking of what the next move was after he exited from Home Run, where can we incorporate technology in an underserved space? And in the hard money space, it just didn't really exist, right? Like a portal where you go to price, submit, and keep track of everything. So that was one of the thoughts behind, you know, starting LendingHome is like technology based for sure.
Awesome.
Broker friendly. So one of the programs that I helped to pilot was the broker program when I first started at LendingHome. That's where brokers can take their clients that are looking for loans, and then they basically shop the loan with their, you know, wide breadth of diversity with lending partners. They find the best deal for the borrower, and then they send them there, right? And then when the deal closes, the lender takes points, and then the broker typically charges points along with those points, right? So what a broker does is they add value by saving the borrower time because the broker finds the best rates and terms for them. They can also provide a wealth of knowledge when it comes to investing, especially if they're working with like people that are new, that maybe a lender won't take the time to, you know, explain to them or so forth. But with LendingHome, we definitely, you know, always make ourselves available and so forth, but maybe the broker will partner with them on deals or whatever, right? So there's definitely a value add that a broker can provide that lenders can't. So with us on the broker portal, brokers can go in there, they can put in the borrower's experience, dealers, and give them instant quotes. So it avoids the hassle of calling back and forth, going back and forth to get a quote. so they can get a faster response to their borrowers. So that was something that for us was a huge value add, the portal, right?
Yep.
So we're definitely broker friendly, to get signed up to get a broker. 29 states that we originate in. So most do not require a license. 22 states do not require a license, and 7 do. In Arizona, I believe it's a mortgage broker's license that you need for that. But in other states, you don't.
So it's very state by state.
Yeah, for sure.
Gotcha.
And as far as rates go, I mean, it really depends on experience and leverage, but, from as low as 7 in California to as high as like 10 in other states at a high leverage and less experience. So it's 7 to 10%. And if you want something a little more like, if you want to know something a little more like concise based on your experience and your FICO and all that good stuff, you can just reach out to me and I'll give you a quick quote. But the general range for rates is 7 to 10% interest only for the short-term loans.
Gotcha.
Cool.
Is this a new, have you always had this program you're going to go over right now?
It is new.
Oh,
So
beautiful. Yeah, because there's such a need for it in, Arizona, because even myself, like, I've got a few that I'm going to give you that I took down with hard money, but now I want permanent financing. So I'm interested to see what this entails.
Yeah, for sure. So it's interesting. We first launched this program in November.
Okay.
We're doing pretty good on it, gaining some traction. And then in March, when liquidity started drying up on the secondary market, our one takeout investor that was buying these loans stopped buying these loans, right? Because of all the uncertainty and, the unemployment numbers and not, in order for people to pay their rents, like people have to be like working, right? So they put it on temporary pause. And in all candor, we didn't think this program would come back until maybe like the fall. We didn't really have a positive outlook on when it would come back because there was so much uncertainty out there. But, confidence came back pretty quickly on Wall Street. And I think that's priced into the stock market if you look at it. So like when liquidity dried up in March, you'll see that it tanked. And then shortly after that, it started to rise until it's actually broke through a point of resistance, the last point of resistance it had before that crash. So yeah, it came back much quicker. It came back in June 1st.
Wow. Interesting. Yeah.
So like a lot of programs that come back, it came back at tighter terms. So it did come back with higher rates and so forth. But since then we've had 2 rate reductions. It's pretty much back to where it was before as far as leverage and pricing. So that's really good. And it says something about the condition of the market in general, right?
Yep.
So this long-term program, you could use it one of 2 different ways. So the first way you can use it is by looking for deals for properties where they're already performing. Maybe someone, is tired of it and they just don't want it anymore and they want to give it up. Or if the property is already rent ready and ready to go, right? That's one way. You can buy it up front. So if you buy it up front, we can go up to 80% LTV depending on the FICO score.
Okay.
The other way you could do it, and this is what I think is more popular, and I think that works very well because you can replicate it, right? It's if you buy something under value, you use short-term money to buy it because then you get more leverage up front, right? With an interest-only payment, which is a short-term loan. And then you work the equity into it, right? So you buy it under value, you work the equity into it. And then when you do the refi, if you're doing rate and term with us, there's no seasoning requirement. So you can finish the rehab and do it right away. When you do rate and term, we cover the loan amount. And then as long as there's enough LTV there, we can wrap all the closing costs into the loan so that you don't pay anything at closing. So that's one way you can do it. Or if you wait 6 months, we can do a cash out refi. And then you can take the cash out, recycle that money, put it towards the next deal, do it again, right? So it's what
I like that concept. And what that is called, I believe. I haven't used it, but I want to use it right, as soon as possible, because I have a couple condos actually that I did exactly that. I seasoned them for about 6 months. So that would be the question I had for you, Julius. Like,
Sure.
How much cash can I pull back out? And that's the first question. The second is, like, I took it to a lender, and well, they're going to do a few of them, but there's a couple in Scottsdale which they wanted to find out what the percentage is of owner occ versus investor. And I don't know, do you guys require, so twofold question, how much of my cash can I pull out? And then do you look at the owner occ versus
Sure.
investor living on the premises?
Sure. So first question for the cash out, we can go up to 70% LTV on cash outs.
Okay.
It's on both the bridge and the rental. So like if you just wanted short-term capital while the property sells, because you're trying to sell it, right, to get some of that money back, the bridge loan is a better option because it's a short-term loan with no prepay.
Okay.
With this one, the spirit of it is you want to hold it for at least 3 years because there is a 3-year prepay. It's 3-2-1.
Okay.
So basically 3 points the first year, 2 points the second, 1 point the third. So but for both, it's a 70% LTV and 6 month seasoning for the cash out. So
Okay.
that's for your first question. And then for your second question, as far as like owner occ compared to non-owner occ, with us, we are just playing with the non-owner occupied space for now. So this would be for rental properties.
Okay. So, there's a little complex in Scottsdale. So do you look at the percentage, like say, so there's 80 units there and I think 70 of them are investors. So there's only 10 units that are occupied by people that live there. So
Yeah.
Do you guys turn that deal away because there's so many investors in there?
Yeah, that's a good question. I could double check for you. I want to say that we don't look at that too much, but I definitely have heard of that scenario for sure.
Okay. Yeah, because the guy that I was working with, so I gave him like 5 or I think 6 deals that I have right now, and I had to pay actually to get the information from HOA, the percentage of owner occ versus I guess it's not public. So I paid him a couple $100 to find that out, and come to find out there's mainly investors in this complex, and they're like, oh, since there's so many investors, we can't help you.
Sure. I think that's part of what makes it warrantable or non-warrantable.
Oh,
right?
exactly. That was the words that they use, warrantable and non-warrantable.
So on the short-term loans, I can tell you we could do both warrantable and non-warrantable.
Okay, but not on like a longer 3, 5, 30 year?
Yeah, on the long-term loans, we're not doing condos yet, but soon we will be.
Okay, so I'm just trying to figure out what I do with those two, because I didn't realize, because my goal was to fix them, keep them as like a BRRRR strategy, so I pull money back out. But now I have that challenge of the fact that they're non-warrantable based on the fact they have so many investors in that complex.
Right. Yeah, for sure. So yeah, for now, like a 1 or 2 year bridge loan could be an option. And then pretty soon we'll be able to do condos and townhomes. We're just kind of ironing out the logistics behind regs and stuff to make sure our docs are right. So
okay, so maybe a bridge loan for that situation with you guys might be something I could do for a couple of years.
Yeah, exactly. Exactly. Cool. And then so on the long-term loans, it is a non-conventional option. So you can put it in the name of an LLC. There's no limit to how many you can do. They don't look at income or tax returns or anything like that. So they have ARM options and 30-year fixed. ARM options will be fixed for a certain amount of time, and then it's variable after that. Often those have a lower introductory rate, right? And then 30-year fixed, you don't have to worry about it. It
okay.
Just, minimum FICO 680, and then for the DSCR, so DSCR is debt service coverage ratio. It's just income divided by the PITIA, right? Principal, interest, taxes, insurance. So if the property is leased, they use the lease. right? So,
Okay. So what about if it's, because I'm getting into these short-term rentals. So like,
yeah.
so, so how do you equate that, Julius, based on
If there's no
annual? Go ahead.
if there's no lease,
There's no lease. There's not going to be a lease on some of these. So it's just, I mean, my Airbnbs will triple what my lease would get. So like, but I don't know how I send you, like, I guess we could just send you the numbers for the month or something. I don't know how
yeah.
you.
So basically, we do a full appraisal on these, right?
Okay.
And then we'll go off the 1007 form, the market rents on the appraisal.
Oh, gotcha. Okay.
That's what we'll do.
Okay.
So it does not have to be leased. I'll just
Oh,
go to the 1007 form.
perfect. Okay.
Cool, right on. So yeah, those are the two different ways we could use it. As far as rates go, it's anywhere from, I mean, our best rate is at 495 at a 50% LTV. So that's at like a 740 plus FICO, right? That's like the best rate. But in general, I would say like of all the combinations of LTVs and FICOs and yada yada, realistically, you'll probably be somewhere between mid fives and mid sixes, just depending on the scenario with LTV and FICO. So, and then with these, and as long as the cash flow, I mean, if you're looking to get into something non-conventional, if the cash flow is there, it's a good investment. And then you could build your rental portfolio with these because there's no limit. You could do 10, 20, 30. I'm working on, I think it's like a 50 pack right now. So awesome. So it could be a one-stop shop for flips and rentals. So when you do the flip loan, we can segue into the rental loan. No problem. So macro level overview, just a couple of things that we saw and are seeing in general. So I'll tell you a quick little story. Back in March, before liquidity started drying up, it was kind of business as usual. Keep doing what you're doing and don't worry about it. And then one weekend when we came back to work on a Monday, when liquidity for individual loan buyers got shut down. So banks, hedge funds, institutions that were buying individual loans stopped buying those loans. So that's when you saw a lot of lenders temporarily bow out or a lot of programs disappear because there were no more takeout investors and lenders weren't going to balance sheet those loans. It's just not a sustainable way to do it. So at that point, I mean, for us, the way that we were able to keep lending were through 4 securitizations that we recently locked up. So securitizations are committed sources of funding as long as they fit a specific box. So if we're working with Wall Street money, sometimes we can do exceptions as long as they have the appetite for it. With securitizations, they just have to fit that box, right? So we take those loans that fit that box, we package them, and then we sell them on the institutional bond market, and that's that. So the box for that tightened a bit when this happened, right? So when we saw that happen, volume started to fall a bit because people started getting more conservative because they were underwriting their deals around our, terms, which tightened up at the time. So to give you an idea of what volume looked like for us, in March, we're going to hit an all-time high. We're going to do over 160 million that month. And then a lot of deals ended up falling out. We did like 110 million. April, things slowed down a lot. So in April, we did 75 million. And on an average month, we're usually doing like 120, right? So in April, things slowed down as a result of people being more conservative, not really knowing what to do with all the uncertainty. And then in May, things picked up a bit. We got up to 95 million. And then when we got to June, we got to 128, I believe it was, July 131. Now we're at numbers we were funding pre-COVID. So COVID or not, things are super busy. People are out there getting deals. People are still buying. So it's kind of remarkable to see how quickly it kind of recovered, I guess you could say. So overall, the outlook is looking pretty good from our standpoint. I think it's a reflection of people still being able to execute on both sides of the transaction. Now, payoff volume, that was another thing that was really interesting that we saw. So as far as people paying us back, houses were still selling. So as we can see, inventory is very low, right? I think you alluded to that a little bit earlier in the conversation, Jason, in the beginning. So inventory is low. It's driving up demand. Things are flying off the shelf, kind of. Throughout the whole pandemic thing, we saw that prices were pretty stable, and now we're seeing prices starting to rise, right?
Yep.
So that's very interesting too. Yeah, over 900 loans in the pipeline. We're seeing more loans than ever before, pre-COVID or not. And then one thing that we saw interesting is of the unemployment filings. I think last month, I don't remember what it is right now, but I mean, at a certain point, I got up to 40 million, right? It's over 40 million at this point. But
There was at a certain point, Julius, not too long ago, I want to say 2.5 months ago. And for anyone watching this that at a later date, we're recording this at the end of August. But a couple months ago, I want to say 3 months ago, 40% of people making $40,000 or less in America had filed for unemployment. 40% of people making $40,000 or less. There was something like, and someone's going to be mad at me because I'm not getting this exactly correct, but it was something like 1 in 3 or 50% of Americans had made a partial, might have been more, it might have been 2/3, a partial or non-mortgage payment. That was as of about 3 months ago. I don't know what it's at now. I think it's a lot better now, but there's some fast facts for you.
yeah, for sure. And then one thing that we saw that the Labor Department reported too is at one point, it was like a month ago, 75% of unemployment filings seem to be temporary layoffs. So, we're hoping that those furloughed employees will get back to work, soon. Some of our furloughed employees came back faster, much faster than we thought they would, which is good too. So hopefully that'll help as it, gets the economy back up and at a faster pace. And
Julius, I'm sorry, I'm just a real quick note because I want to respect everybody's time. And I know that Flip and I our banter kind of ran long, but I want to make sure that we're wrapped up by about 7:35 at the latest. And I want
okay, yeah, I'll be
7:30 for some Q&A.
Okay, cool. And then the last thing about that, one thing that I found very interesting is just overall watching the stock market. On March, like around March when things started getting dry in liquidity, I mean, we hit a bottom. We saw the stock market tank, right? And then since then, it's been steadily rallying. This last point of resistance that I was kind of talking about earlier, I mean, it's broken through it. So, I think the rising confidence on Wall Street is kind of priced into that. So I think it's a good sign too. Okay, last thing I got for you is a case study. So a loan, an example. So I thought I'd pick one in Phoenix that we did recently. So for this one, it was a duplex, I believe. This one, we're looking at a purchase of 180, rehab of 48, very cosmetic, and then an ARV of 280, right? So this is someone that was approved on the Bridge Pro program. So this is someone that went through the one-time upfront approval with over 5 flips in the last 2 years for their experience, right? And they submitted the contract, the budget, some pictures, who they're working with for title and insurance. That kind of gets the clock ticking and kicks it into processing. So when we came back with our ARV, I think it was pretty close. I think it was like 270 when we did the ARV, right, ourselves, because we do an ARV. We're basically looking for comps, sold comps, 1 mile radius, far back as a year, looking for sold comps that have sold in repaired condition, right, based on that rehab budget. So if you give us a robust scope, it could help with the valuation process, right? So in a day or two, we saw that we could go max leverage, right? Option of 85% LTC. However, when this borrower confirmed terms, they opted for a slightly lower leverage for a slightly lower rate. And based on the overall experience and the deal and so forth, we funded this one at 9%. So just a quick example of one that we did before. And yeah, so just know that if you put more money down, you can get a slightly lower rate. Most people tend to go higher leverage, so that way they have more buying power. But I mean, it's completely up to you, right? And then again, no two deals are alike, and no two investor profiles are alike. So if you'd like to learn a little bit more about what we can potentially offer you, let's chat and we'll see what the situation is. And I'm happy to try to find some tailored solutions for you that'll work for both you and LendingHome. So that's all I got for my part, at least.
Julius, thank you so much. I want to ask you real quick, how do people get in touch with you if they want to talk further with you?
Yeah, absolutely. So that's my phone number. Here, I'll look at this slide. My phone number is on the bottom left of this slide. It's 415-202-6245. If I don't answer, leave me a voicemail or email me. I mean, as you can probably imagine, we get a lot of phone calls. So if we get an email or a voicemail, I could text you back or email you back, and we can set up a time so we don't miss each other. But yeah, call or email is great. So 415-202-6245 or Julius@lendinghome.com.
Perfect. Quickly, my information for title, if you guys need title. And by the way, I should mention, we give a 30% discount for investors on title fees. So that can save you guys a lot of money when you're doing a deal, and every little bit counts. So reach out to me. My email address is in the chat log. And if you're just listening to this, then my email address is Jason, Jason, Heinen, Jason.Heinen, Heynen, that's N like November, E like Echo, N like November, at magnustitle.com. And Flip, you want to throw in a quick plug for yourself?
Yeah, absolutely. Thanks, Jason. And I could definitely vouch for these two guys. So if you're listening, what I like about both of them is the service-oriented, the way they handle stuff. If you have a question or problem, they're going to address it real quick. So I could definitely testimonial for both guys. For myself, the best way to reach out to me is on Instagram, and it's just Flippin, FLIPPIN _AZ, and you can just send me a DM, and I'll respond that same day.
Very cool. I want to give an opportunity to anybody on the call to do a quick Q&A. I know we're pushing up against a 7:30 time frame. Maybe we can push it to 7:35. Are there any questions, any points of clarification for what we're doing here? I'd like Julius to answer any questions. Philip Zweig is Fix and Flip mentor. So if you have any questions for him or questions for title, marketing, and data, that would be me. Anybody have any questions? Please fire away. Okay. I think that's just about it.
I had a couple. Let's see. Daniel had one. Do I offer mentorship, Flip? Yeah, we're structuring some programs right now, Daniel. I don't know what part of the country you're in, but definitely hit me up on DM at Flippin _AZ, and we could chat more, offline about mentorship and what I provide as far as helping you get started and, helping you get into it. The question I had for you, Julius, you mentioned you're in 23 states?
29 now. I should.
29. Okay.
Yeah.
Excellent. So, would people reach out to you for all the states?
Yeah.
Okay.
Yeah. So my focus right now is mostly California, but that's for initiatives where I'm actively looking for people for us to work with. But if I get a referral or if someone comes to me from Florida or Michigan or Ohio, it doesn't matter. I can absolutely work with them. No problem.
Beautiful. And, being in the game 2 decades, I'm still learning all the time. So I learned tonight, programs change all the time. So just being able to educate us and inform us, I really appreciate your time, Julius.
Yeah, absolutely. I appreciate yours, Flip and Jason. Really happy to be here, and looking forward to seeing what we can do together in the future and who we can help out.
Absolutely. Likewise. Hey, Daniel, thank you. I see the thank you message down there. Thank you. Make sure that you hang on to Flip's information, Julius's information, and my information. Again, I'm a title marketing manager for Magnus Title Agency, and I can help you in a lot of ways. I help you market, I help you get deals, I help you with data, and I get you great fees and discounted fees and rates on on title. So keep my information. Otherwise, I think we're just about done here. Is there any last thoughts or feelings, compliments, complaints anybody wants to throw out there?
Well, I know a lot of folks wanted to be on here, Jason, and I did stream it on my Instagram, and we had like 20 people watching us. So
Very cool.
one of the questions that we got on Instagram is like, where if they chimed in late and missed some of the teaching, are you going to send me the link, or where can they find the full, the full night of
the video?
Yeah, the video.
Sure. What I'll do is I'll try to post it on Flipp Arizona on Facebook, Flipp with 2 P's, Flipp Arizona. I'll send you the link as well for you to post your platforms, and I will hang on to it as well. So
excellent. Between us, we'll get it out there.
We'll get it there. Yeah. Cool.
Excellent, guys. Well, stay safe. Julius, I'm going to reach out to you tomorrow on some deals and get that application over. And Jason, let's definitely keep the ball rolling. And I'm hoping to see you live next week, Jason.
Likewise. Let's crush some deals, guys. And I think I might be hosting